Over IRS Form 8960, Net Investment Income Tax for Individuals, Estates, and Trusts. So this is a pretty simple tax form in that it's only one page consisting of 3 parts. However, there's a lot of complexity that can go into this tax form. So before we begin, let me outline what we're going to do. We're going to go through the 3 parts of this tax form. Then we're going to go through this as if we were in the shoes of our hero, John Doe, an individual income taxpayer who may or may not be subject to the net investment income tax. We don't know quite for sure. As we go through this form, we'll make that determination. However, this form can also be used for complex situations, estates, trusts, things of that nature. To put it into perspective, this tax form is 1 page long and the IRS instructions are 22 pages long. So for the purpose of this video, we're going to go through this from the eyes of an individual income taxpayer. There are going to be a lot of maybe long tail exceptions or provisions, things that could happen. We'll briefly discuss those, but the things that are not applicable to the vast majority of income taxpayers, I'm going to defer to the article. So there is an article that goes through each line step by step in great detail, not 22 pages of detail, but enough detail for someone that needs to get into the nuances, into the weeds. They can do that in the article. So let's briefly go over the 3 parts to this form. In part 1, we're going to go over all the items of investment income that go in lines 1 through 8. In part 2, we're going to discuss investment expenses that are allocable to investment income and modifications. And again, investment interest expenses can be deducted. Where they're deducted depends on whether or not those expenses are allocated to investment income or if they're allocated somewhere else. And then part 3 is the tax calculation. So we'll go over each of these parts, but again, we're going to kind of keep the details focused on individual income taxpayers. So at the top of this, we're going to have our hero, John Doe, and we're going to say that, let's just imagine that he makes, that he is a married taxpayer filing a joint return with his wife. And in that case, there is a table in the form instructions and in our article that goes over, the income thresholds for the net investment income tax. So for a married couple filing a joint return, that would be $250,000 of a modified adjusted gross income, or MAGI. For a qualifying surviving spouse, the income threshold is $250,000. For married couple filing separate returns, it's $125,000. And for either single or head of household filers, the threshold is $200,000. So at the very top of part 1, there are 3 provisions. So you would check if these are applicable, either Internal Revenue Code section 6013G, 6013H, or Treasury Regulations section 1.1411-10G election. If you know what they are, then you would check the box. If you do not, the odds are pretty likely that that provision does not apply to you. So I would, if you have any doubts, you can take a look in the article. However, most likely, if you don't know what those provisions are, then you don't need to check them. So in line 1, you would enter the taxable interest. And again, in our article, we go over all the different types of forms that would apply. In this video, we're simply going to go over where you would find this on your Form 1040 under normal circumstances. So taxable interest would be what is reported on line 2B of your Form 1040. Let's just say that John Doe had $5,000 of taxable interest. In line 2, you would enter the amount of ordinary dividends from your Form 1040. This would be on line 3B. So let's just say that this is $3,000. Annuity income, this would be gross income from all annuities except for annuities coming from a qualified workplace retirement plan, Section 408, so that would be IRAs, Roth IRAs, or deferred compensation plans. And you would normally see this income reported to you on Form 1099-R. So amounts that are subject to the net investment income tax would be identified with a code D in box 7. So if code D is shown on box 7 of your Form 1099-R, then you would include that amount on line 3. So let's say that that is $10,000. And let me make sure that I clarify that point. If there is a code D in box 7, you would report the taxable amount that's reported to you in box 2A of that Form 1099-R. So any tax forms that I mention here, if we've created articles or videos on that tax form, we'll put links to those in the show notes. In line 4A, you would enter any income from trades or businesses, rental real estate, royalties, partnerships, S corporations, and trusts. So this would come from either line 3 or line 5 of your Schedule 1. So let's just say that this is... now in line 4A, you would make an adjustment for net income or loss derived in the ordinary course of a non-section 1411 trade or business. So these would be gains or losses that are excluded from the calculation of net investment income. We're going to assume that in this case there are no adjustments, so we're simply going to bring that number down, and we have $25,000. In line 5A, lines 5A through 5D, we're going to calculate the net gain or loss on the disposition of property. So generally, net gain from the disposition of property that's not used in a gainer business or in a trader business, and net gain or loss from the disposition of property held in a section 1411 trader business, those are included in net investment income if it's included in taxable income. So in line 5A, we're going to enter the total amounts from line 7 of your Form 1040 and line 4 of your Schedule 1. And then in line 5B, we're going to enter the net gain or loss from the disposition of property that's not subject to the net investment income tax. So we're going to assume in this case, for John Doe's sake, that everything here is subject to net investment income tax, and there is no adjustment from any disposition of partnership interest or S corporation stock. So that's line 5C. Basically, if you sold any of your partnership interest or S corporation stock, you would go through a worksheet that's located in the form instructions, and then you would attach a statement to your tax return for the year of disposition. So we're going to combine those here. We're going to make any adjustments to investment income for certain uh, CFCs and PFICs. These are foreign entities which John Doe does not have any interest in, so these will be zero adjustments. And then any other modifications to investment income, and there's a whole slew of modifications that could be included. Items that would generally not be included on as taxable income. For example, amounts reported on IRS Form 8814, which is a parent's election to report a child's interest and dividends, substitute interest and dividend payments, so on and so forth. We don't have any of those here, so what we're going to do is we're going to combine all of these items here. So let's see, that's 30,000, 43. Let's just say that this is $63,000 total. Now in part 2, we're going to calculate the investment interest or the investment expenses that were allocated to investment income. So in line 9A, we're going to enter the interest expense that you paid or accrued that was deducted on Schedule A of your Form 1040 on line 9. So let's just say that we had $10,000 of investment interest expenses. In line 9B, we're going to include any state, local, or foreign income taxes that were paid for the tax year that are also attributable to net investment income. So not necessarily sales taxes, but income taxes. So let's just say that this was $2,000. Now in line 9C, we're going to enter any miscellaneous investment expenses. You would see these generally on IRS Form 4952, line 5. We're going to total those up into line 9D, and we have $17,000. So any additional modifications, you would enter them on line 10. There are special rules for traders in financial instruments and commodities. We don't have any, so we're going to put a 0 here, and then we're going to carry this $17,000 down. Now, we're going to subtract the line 11 number from the line 8 number, and we arrive at so this is where individuals go in one direction and then estates and trusts go in a different direction. So, and the reason why is because estates and trusts have slightly different rules, but then they also have much different tax brackets. So in our article, we kind of walk through both scenarios. In this video, we're only going to go through this case for John Doe. So let's just say that John Doe's modified adjusted gross income as reported on line 13. So that would be adjusted gross income plus foreign earned income exclusion from your IRS Form 2555, plus any adjustments for certain CFCs and PFICs. Let's imagine that John Doe excluded $10,000 worth of income, and then on top of that, he and his wife reported $300,000 of income. So that would be $300,000, $310,000, and then their threshold was $250,000. So we would subtract the line 14 from line 13, and we arrive at $60,000. Now we're going to take the smaller of either $60,000 or the $46,000. We're going to enter that here in line 16. We would multiply this amount by 3.8%. and we arrive at $1,748. So that is what we would put on our income tax return under, I believe, Schedule 2, which is the, yeah, Schedule 2, line 12. That's the schedule that reports additional taxes. So if we were going through this as an estate or trust, we would do something very similar. We have the net investment income here. We have a couple of either deductions or additional, I guess, considerations for income. So whether we distributed or retained investment income, and then we would use a different tax bracket. Again, we cover all of this in detail in our article, so please check that out. So for John Doe and Mary Joe, the most important takeaway is that we do the part 1 and part 2 calculation. We come up with a computation for the total investment income, and then we do a separate calculation based on modified adjusted gross income against the tax threshold. So, and then we take the smaller of those two and we calculate the tax. So let's imagine really quickly that we had a much lower income amount here. Let's just say that we only had 5,000 of in line 5D from the gain and disposition of property, and we had 5,000 from the rental real estate royalties, partnerships, and so on. Then we would recalculate this. This would be 10, 20, 28,000. And then we would have $17,000 of deductions and modifications, which would mean that we would calculate this tax on $11,000 of income, because that would be the smaller amount. And then that's how we would do that, basically. Oops. Thought I carried a incorrect decimal, so I had to move that decimal over to the right one spot. So your net investment income tax as an individual taxpayer really is calculated based on the smaller of your quotes net investment income, or the actual net or the modified adjusted gross income after reducing it by the threshold. So if your overall modified adjusted gross income is below your threshold amount, or if you have zero net investment income, then you will not be subject to the net investment income tax. So that's all we have for this video. You can go into a little bit more detail, and there's a lot of nuances that we didn't cover in this video. If you want to check them out in our article, simply go to the link in the show notes, or go to teachmepersonalfinance.com, type in IRS Form 8960, and you'll see the article up here. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions or comments, or if there's a topic that you'd like to see covered in an upcoming video, please hit me up in the comments section. As a last note, there are a couple of worksheets that I have done videos for at certain points in this form. I will put links to each of those worksheet videos in the show notes as well. So thank you very much and have a great day.